UTI Nifty50 Index Fund, an open-ended scheme replicating tracking Nifty 50 index. Passive investing, a hassle-free investment option. Investing in stock market comes with tricky questions. Which stocks should I pick? Or even trickier, when should I buy or sell? For many, this stress leads to hesitation, missed opportunities, or wrong decisions. But what if you could invest without worrying about stock picking, market timing, or relying on a fund manager's choices? Welcome to Passive Investing, a simple, efficient, and non-discretionary way to gain market exposure. Instead of stock picking, invest in a diversified portfolio of stocks through an equity index fund. Obvious next question is, what is an equity index and equity index fund? Simply put, an equity index is like a defined basket of stocks, selected on the basis of fixed rules, escaping personal biases. It represents a market segment like the market capitalization, large cap, mid cap, small cap, or sectors like bank, auto, etc., or any other factor-based strategy or investment themes. An equity index fund follows a specific index. It holds the same stocks in the same proportion, eliminating discretionary risk and offering market exposure without stock selection worries. The simplicity is making it progressively popular among investors. How to compare and select an equity index fund? With all equity index funds tracking the same index, unlike other fund categories with unique strategies, how do you pick the right one? Here are 4 key parameters. 1. Experience. Longer track record shows expertise in managing funds efficiently. 2. Scale. A large fund size, AUM, reflects strong investor trust and better execution. 3. Track record. Tracking error measures daily return variations from the index. Tracking difference measures the annual return gap with the index. Lower values for both mean the fund is closely following the index. 4. Cost. Lower expense ratio helps investors keep more of returns. One key advantage of passive investing: lower costs. Since index funds simply mirror the index, they avoid high fund management fees and frequent trading costs, helping you grow wealth more efficiently. Yet, to begin a passive investing journey, step in with confidence with UTI Nifty50 Index Fund. India's largest and one of the oldest equity index fund, UTI Nifty50 Index Fund follows the Nifty 50 index. India's top 50 blue chip companies across sectors reflecting overall market performance. These companies are well diversified, highly liquid, and less volatile than mid and small cap stocks. Investing through a Nifty 50 index keeps your portfolio aligned with the market's best most times. When you invest in UTI Nifty 50 Index Fund, you rely on collective market wisdom, investing in India's largest and most trusted companies such as Reliance Industries, HDFC Bank, Infosys, ITC, and many more, all in a single investment in the same proportion as the index. This gives diversification, liquidity, and long-term growth potential. Why to invest in UTI Nifty 50 Index Fund? 1. It is one of the oldest equity index fund since March 2000 with the largest AUM. 2. Experienced 25 years of efficient replication strategy with smooth fund execution. 3. One of the lowest tracking errors and tracking differences in the industry. 4. Highly competitive expense ratio. Who should invest in UTI Nifty 50 Index Fund? Investors seeking low-cost market exposure without stock-picking hassle. Young investors or beginners looking to start wealth creation. Investors wanting a diversified investment that reduces company or sector risk. Index fund investing is not about predicting the market. It's about participating in it. Go passive. Participate today with UTI Nifty 50 Index Fund. Keep it simple, because simple is often smarter.
To know more, contact your mutual fund distributor or registered investment advisor or call 8655019940.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.